I'm Adam Myers. Thank you for joining us for this webinar update with James McDonald, the portfolio manager of our most exciting fund, the Pengana High Conviction Equities Fund. The fund has a long track record of generating significant outperformance, and for the most part, this has been done by investing in extremely dynamic companies that are either under-researched or their impacts are just not fully appreciated. On the webinar today, James will be joined by Jeremy Bendach, who has recently joined the team as a portfolio manager. Jeremy has over 25 years of financial markets experience with a focus on small cap investing. We believe that his skill set will be highly complementary. Today, James and Jeremy will explain what they look for when making their investments, the current positioning of the fund, and they will also provide some insight into some of the holdings. During the presentation, if you have any questions, please enter them in the Q&A box, which is accessed from the icon on the bottom of your screen, and we will get to as many of them in Q&A at the end. James, over to you.
Thanks, Adam, for that introduction. I'd like to start thanks everyone for joining today. To start with, I'd like to go through a bit of an overview of the fund, including the team, then touch on the macro and outlook, do a deep dive into some of the stocks, and then a quick summary of the fund. So, as Adam mentioned, I'm very pleased to announce today that Jeremy Bendach has joined our team. He's got 26 years of experience, previously at Avoca, UBS, Colonial First State, and the Australian and New Zealand Treasury. I've known Jeremy for 15 years and really looking forward to working together with him. Veronica Price is our equity analyst, who's got 4 years of experience. Prior to joining Pengana, she was at Macquarie, and we've worked together for about 2 years. As you know, I've got 24 years of experience, and prior to joining Pengana, I was at Hunter Hall and BT Funds Management. Just to have a quick overview of the fund, it's a high conviction fund concentrated with 20 holdings, a maximum of 20 holdings. The fund does have high exposure to the healthcare sector, around 40%, and I'll go into some more detail about that later. It can invest in both small and large cap companies, which is somewhat unique, and can also be invested in Australia, and maximum of 20% invested in Australia. It's both a mix of growth and value stocks, and it's got a negative ethical screen across the fund. It doesn't invest in anything that's harmful to the environment or society, and ESG is integral to the process. Stocks are weighted in the portfolio by their upside and their level of risk, and I'll go into more detail on that later on. It can hold 100% of the fund in cash, but in reality, it doesn't have more than 20%. Very pleased with the long-term track record of the fund. Over the last year, we're up 41%, significantly outperforming the MSCI World Index of 23%. And since inception, the fund has risen 32%. That's July 2017, so almost 4 years ago, significantly outperforming the MSCI World Index of 12%. As I mentioned, the last year's been very pleasing. The main contributor to that outperformance has been healthcare stocks. On the right, you can see some of the main contributors there. Telix, an Australian radiotherapy company, rose a great deal over the last 12 months. I'll go into more. I went into a lot of detail on Telix last year when I presented to you. I don't plan to present that today, but it is included in the appendix to this presentation. The same goes with Photocure, a Norwegian bladder cancer company. I spoke to you about that last year. It's performed very nicely, also in the appendix. Novavax is a COVID vaccine stock, has been a great contributor. Howard Hughes is a US property developer, which I plan to speak to you a bit more about later. And Immutep is an Australian immunotherapy company. So what are we looking at? What are we looking to find in a stock or an investment? Most importantly, it should have a strong competitive position. That could be a technology, a low cost of production, a brand, a network effect, but a really strong, unique selling point, if you like. Also extremely important is that the investment should be trading at a significant discount to its intrinsic value. And I think that generates strong upside returns and gives you downside protection. Obviously, if you can find companies that are under-researched, out of favour, or have some hidden value, you tend to do very well out of those stocks. It's not the only way to make money. You can also do well, obviously, out of large stocks like the large internet stocks have been wonderful performers, but those three characteristics do tend to lead to strong returns. We love it when a company has strong cash flow generation. If it doesn't have strong cash flow generation, we like the company to have a strong balance sheet. So a large cash balance, for instance. Quality of management is really important, and we like the management to have an aligned incentive structure with us, the shareholders, so share options or even better, share ownership in the company. So how do we construct the portfolio? Firstly, we think about what's the upside of the investment. And to do that, we have to calculate the intrinsic value of the company. We think about free cash flow generation as the primary tool in calculating that intrinsic value. We look at the business model, the competition, those sort of factors, quality of experience of management, and also looking for catalysts to re-rate the shares. The second thing we do is look at the risk of the investment. How much debt does it have? How volatile are its earnings? How liquid are the shares? Can we get in and out easily? What country are the shares listed in? We tend to mostly invest in developed markets, but if they're in emerging countries, you have to be cognizant of things like currency risk. So when we have those two factors, we look at the upside and the risk, and we use those two things to weight the stock in the portfolio. As I said, maximum of 20 holdings, and a single stock can't be more than 15% of the fund. We have country limits, which you can see here: USA 60%, UK, Japan 30, other developed countries 20, Australia 20, and emerging markets in total 20. You can see the sector limits there. Healthcare can be up to 50% of the fund, and all other sectors can be 30. With that, I'd like to hand it over to Jeremy to discuss the macro outlook and strategy.
Thanks, Jim. The world is improving at a rapid rate. Monetary policy is quite loose, and fiscal policy has also been quite stimulative. Combined with a vaccine rollout, this is supporting a very strong economic recovery. One of the concerns about this recovery is not so much its pace, but whether it will lead to inflation. We have invested and focused on stocks that do have pricing power and that are positioned in industries with growth. And we think those types of stocks, industrials with growth and pricing power, are likely to outperform if bonds do rise. An example in the portfolio is Keysight. China is likely to reduce its economic stimulus as it's already rebounded very strongly. That leaves the United States well positioned post-Biden to be the anchor for economic growth in the world. We have exposure to the United States through stocks like Howard Hughes, which Jim will speak about later, and we're looking to increase our percentage of stocks that are held so that we can get more leverage to that US economic rebound. Markets have priced many of the reopening trades, but we're still looking in some unloved sectors for opportunities. We need to position, however, for the unfortunate circumstance that COVID-19 is not just a pandemic, but it will be endemic, which, like the flu, will require regular vaccinations in ensuing years. Examples in the portfolio that are beneficiaries of this phenomenon are things like Merck and Novavax. We're very excited about the acceleration in the world's move to decarbonize, and this will provide a tailwind to many sectors and a headwind to others. The team's working on finding unique business models leveraged to this thematic, and we are researching things like automakers and energy utility software providers that may provide leverage to this thematic. We still think there is a large unappreciated number of stocks in this area that we can find great opportunity in. I'll hand back now to Jim to continue.
Thanks, Jeremy. I'll just now go through take a deep dive into three of the significant investments in the fund. Obviously, there's many other investments, but I thought I'd talk about three that I think are interesting and that I haven't discussed with you before. So the first company is Immutep, an Australian immunotherapy cancer producer. We first invested in this company in November last year, but when the share price was 25 cents and it's now about 57 cents. When we invested, the market cap of the company was $170 million and it had $55 million of cash. So you might remember before I said when companies aren't generating cash flow, we really like them to have a strong balance sheet. And you can see an example of that here. The company had a very small market value compared to the potential revenue opportunity, and I'll go into a bit more detail on the next slide. Their main drug is a drug called eftilagimod. It's unlicensed, so it makes the company an attractive acquisition target. It's got encouraging clinical data recorded in 3 indications: breast cancer, lung cancer, and head and neck cancer. And it's partnered with 2 of the largest pharmaceutical companies in the world, Merck USA and Pfizer. And they haven't licensed the drug yet. They're just conducting joint clinical studies. Potentially, they would be logical acquirers of the company. Recently, BMS, or Bristol Myers Squibb, has reported positive phase 3 data with a similar class of drugs called the class is called LAG-3. That was in melanoma, so a different indication, which has validated the whole class and created a lot more interest in the sector. The FDA about 2 months ago granted fast track approval for FD in head and neck cancer, which will accelerate the speed at which that drug could get approved, possibly 2023 or 2024 if all goes smoothly. And that's about a $2 billion market opportunity. And there's a lot of transformative data readouts over the next 12 to 18 months. We should get more details beginning in ASCO on the 4th of June. We had a little taste of that data last week, but we should get more detail in 2 weeks' time. As I mentioned, it's doing studies in 3 major indications. On the right-hand side, you can see the market size of the immunotherapy drug market in these cancers. They're really vast: $30 billion in breast cancer, $23 billion in lung cancer, and $2 billion in head and neck cancer. As I mentioned, they're conducting those 3 trials with MSD, which is Merck USA, and they've expanded the TACTI-002 is ongoing, and the size of that study has been expanded. We'll get continuous news flow from that over the next 12 months. And they're about to start this study here, TACTI-003, in head and neck cancer, which is a phase 2 study, but potentially will be enough to get the product registered in say 23 or 24. They're also conducting studies in solid tumours with Pfizer, and we're getting some initial data on that in 2 weeks at the ASCO conference. Just to touch on some of the data as to why this is exciting, you can see Pembro is Merck's drug, Merck USA's drug. They sell about $20 billion a year of this drug. the patents expire in 2026, and Merck is very keen to find ways to extend that patent life and protect that business. So they're very active in acquiring small companies that can help them do that. They bought an Australian company called Viralytics 2-3 years ago for about $450 million. But there's a range of acquisitions in this sector now happening anywhere between $1 billion and about $6 billion. So there could be substantial upside if Merck was to, or any of these large cancer companies was to buy Immutep. In this case, you can see Pembro had a 17% response rate, and Immutep had a 50% response rate. Pembro had a 2% complete response rate, or effectively a cure, and Tacti had about a 17% cure rate or complete response rate. So substantial improvement over Pembro. This is actually, Tacti is Immutep's drug combined with Pembro. Pembro is a wonderful drug, but it only works in about 20% of cases. So the market is really keen to find ways to expand the immunotherapy drug class. And the great thing is that immunotherapy has so much fewer side effects than chemotherapy. It's really much better for patients. You can see above there's some data on lung cancer as well. I won't go into that, but suffice it to say that FD is showing a significant improvement over Pembro. The next stock I'd like to talk about is Howard Hughes. This is a US property developer. It both owns property and big tracts of land, which it slowly sells off blocks of land to housing companies to build houses. It doesn't really build single family houses, but it does build blocks of apartment. It also builds commercial premises like hotels and office blocks, and it retains those properties to create a long-term annuity stream. So it's a somewhat unique business model, possibly a bit similar to Stockland here in Australia. We like it because it provides us to rising land prices in attractive US cities, really in 4 major cities: Honolulu, Las Vegas, Houston, and New York. It generates strong free cash flow generation. It's selling off its non-core assets, and it's trading at a significant discount to its NAV. Howard Hughes, the aviator, bought this first block of land in Las Vegas in the 1950s, and he really consolidated and cleaned up the casino industry in Las Vegas as well. It's a really vast block of land. You can see when it's fully built out, it will house 200,000 residents. It's considered one of the most desirable suburbs to live in Las Vegas, and with great schools, hospitals, office blocks, etc. Interestingly, Las Vegas is actually geographically constrained by mountains and national park. So the supply of land is capped, which leads to strong long-term growth. It's 22,500 acres, and it's 9 miles from the downtown strip area. The second block of land is Ward Village in Honolulu. For those of you been to Honolulu, you can see Waikiki Beach here to the south. This is to the north of that, and there's a marina there. So it's attractively situated. The company has plans to build about 13 high-rise buildings on this land over the next 10 years. They get very good margins. There's great demographics in Honolulu. You've got both the Japanese and West Coast Americans loving to go there on holidays. And there's been a shortage of housing built over recent years. The next block of land is the Seaport District in New York. This is very close to Wall Street. Similar dynamic to Covent Garden. It will be finished at the end of this year. Some of it's already open, but a large new food hall called the Tin Shed will open in the next few months. And they're planning to put a large residential building at the rear of the block. Gives you a bit of a flavour of some of the land they own. As I mentioned, we really like this as a play on land growth, and you can see over the previous 10 years, Bridgeland's in Houston, where land prices have grown on average 6%, and Summerland, they've grown at 9%. Actually, the price growth over the last year has been much higher than that, but gives you an idea of the long-term trend. The company's trading a significant discount to the NAV. This is the company's calculation, which they say around $150 per share, compared to around $105 per share at the moment. Even if we take a discount to the company's valuation, still decent upside to the share price. Of course, if land prices were to grow more quickly, then there would be further upside to that number. The operating assets, as I mentioned, are the company keeps its commercial properties that it's developed. The master plan communities are the land banks that it owns, and that it's going to gradually sell off over the next 20 or 30 years. Ward Village is Honolulu, the seaport in New York, and then non-core and corporate expenses there. But we still think it's a nice place to be long term. Interesting, Bill Ackman, the famous hedge fund manager, is the chairman of the company and has been increasing his stake. Currently owns about 23% of the company. Next, I'd like to speak about Rakuten, which is Japan's largest e-commerce company. They're just a little bit ahead of Amazon, both with about 30% market share. It's a unique business model because Rakuten is also got a very large fintech business, which Amazon doesn't have. It's the largest credit card provider in Japan. It's the largest online bank in Japan. It's the second largest stockbroker in Japan. The reason we're interested is the share price has massively underperformed all the other e-commerce platforms over the last 4 or 5 years because the company decided to build Japan's 4th mobile network. And the reason it's doing that is it sees great synergy between the various businesses, e-commerce, fintech and mobile. They know that people who use their mobile phones spend 50% more on their e-commerce shopping site, for instance, and also take up their other services. So it's 80% built out at the moment, but it's heavily loss-making. They're just starting to add subscribers to the network. We feel over the next year that the company forecasts that the mobile business will break even in 2023. And we think at some point the market will re-rate the company as people focus on the synergies that this is all creating. Just to give you an idea of the value, Rakuten's got a market cap of about $19 billion US. Coupang, which is South Korea's largest e-commerce site, that has no fintech business, listed recently and has a market cap of $68 billion, which is 3.5 times the size of Rakuten. It barely makes any profit. So, the market is ascribing a very, very large negative number to the mobile network of Rakuten, and we feel that's the opportunity here. So this is the e-commerce business has been growing very nicely, 28% year-on-year revenue growth. Operating profits are not growing as quickly as revenue because the company's investing heavily in logistics. And just while we're on that point, I should mention that 2 months ago, Japan Post, which is the post office of Japan, bought an 8% stake in Rakuten. Japan Post has 27,000 post offices in Japan, which will greatly help reduce the delivery costs, the last mile delivery costs for Rakuten, which is losing a substantial amount of money in rural areas. Additionally, the post offices will sell Rakuten's mobile phone services. An unusual feature of the Japanese market is Japan Post is also one of the largest banks in the world. And so there'll be synergies in selling Rakuten's financial products, such as credit cards, to its banking customers. So it's a really interesting collaboration. We won't see the benefits of the logistics business until mid-year when that starts. But that's very interesting. Tencent also bought a 4% stake. Tencent's one of China's largest internet companies. That's more of a passive stake given the political tensions between the two countries. And Walmart's Japanese subsidiary, Seiyu, bought a stake and the companies plan to do online groceries delivery together. So some interesting tie-ups have been announced recently. As I mentioned, Rakuten is the largest credit card company in Japan with 22 million credit card holders, and they're accelerating their rate of acquisition of credit cards. You can see it only took them 3 months to acquire the last 1 million credit card holders. Previously taken them about 5 months to add 1 million card holders. So encouraging sign there. They're the largest online bank in Japan, with customer accounts now standing at 10.5 million, up 21% over last year. And they're the second largest stockbroking securities firm. And you can see the great speed, the great acceleration of which they've added accounts in the last few years. They've now surpassed Nomura, which was always Japan's largest securities broker, and they're just behind SoftBank, but catching up quickly. I should also say Rakuten is Japan's second largest online travel company, behind JTB, Japan Travel Bureau. That business is quite depressed at the moment, so as we get an economic recovery, we should see a pickup in their travel business. Obviously, the growth will moderate in the online business, just as the COVID base effect passes, but we do believe there'll still be positive growth. Now, the main negative factor, as I mentioned, is this mobile business, which is heavily loss-making. On the top line, you can see the mobile business revenue growing 44% year on year, but the operating losses are really growing. They've built out the network. It's 80% coverage of Japan, plan to get to 96% by summer. So the network depreciation expenses are getting fully loaded, but they're only just beginning to add subscribers. They have an interesting pricing model where the first gigabyte is free. First gigabyte of use per month is free, and then after that you start to pay. There's still a substantial discount on all their pricing tiers compared to the other three major companies. Japan historically has had very, very high mobile prices, so Rakuten's looking to come in and disrupt that market. They actually have developed their own mobile technology that has they say, a significant advantage over other companies' equipment, allowing them to roll out their network much more quickly. They own a majority of a US telecom equipment company called Altiostar, and they plan to resell that equipment to other new entrant 5G and 4G mobile operators around the world. So that will be an interesting aspect of their business if they're able to do that. Certainly nothing in the price for that equipment at the moment, given, as I mentioned, the $20 billion market valuation. Can't say exactly when the losses will peak in this business. We do know that that initially the subscribers go on with 0 gigabytes for free, but within 9 months, they've doubled their usage and are starting to pay. So I think we'll get this effect where we add a lot of subscribers, and then there'll be a lag effect where we'll see the revenue start to come. As the subscribers are growing quickly, they had 1 million subscribers in June last year. They've now got 4 million subscribers. They only just got approval for the Apple iPhone on their network about 2 weeks ago. Previously, you could obviously buy an Apple phone outright and use it on their network, but they couldn't offer bundled packages to their subscribers. So we think that will accelerate their subscriber acquisition in coming months. And as I mentioned, we're going to get Japan Post starting to sell their phones in their 27,000 post offices as well. And just to reiterate why they're doing this and why this makes sense, this is just looking at the cross-use of Rakuten mobile subscribers who sign up to the network. So new subscribers who sign up to the mobile network, 1 in 3 start using their marketplace, 1 in 6 start using Rakuten Pay, 1 in 7 start using Rakuten's credit cards, and 1 in 10 use Rakuten Bank. So you can really see the synergies, and I guess what we would hope to see as they add more mobile customers to their network, that actually we get an acceleration in the usage of their other businesses. So that's it from me. I'll just hand back over to Jeremy to quickly sum up.
The presentation has been a snapshot of some of the stocks we hold, and we thank you for your investment in the fund, which captures many more of these high conviction ideas. The process has proved robust during some pretty trying times, and we're very, very bullish about how well the world is getting both economically and health-wise, and that provides a nice backdrop for investing. The fund is well positioned for this improving outlook with both a mix of growth and value stocks. And we're very pleased with the recent returns. The team's been strengthened, and we will strive to deliver on your expectations in 2021 and beyond. I'll hand you back now to Adam for the Q&A.
Thanks, gentlemen. That was a very comprehensive overview. Number of questions here. I am going to try and lump a few of them together. So if you don't hear the exact question as you asked it, the answer will probably be sort of included in a more composite question. Firstly, a few questions on inflation. Do you see it as transitory or permanent? As
a former and still passionate economist, the transitory nature of inflation is being seen as a result of two main factors. Inflation is always a result of two main factors. One of those factors is we have had a supply shock as a result of COVID, making it hard to move goods around the world, and a production shock in many businesses has resulted in employees and scheduling of production facilities being quite challenged as a result of COVID. When we layer on top of that the increased demand for many goods and commodities as a result of consumption switching away from experiences and restaurants, travel, we have what we think is a period of abnormally large amounts of inflation. Whether or not this is transitory or not, it would seem that there is, prior to this pandemic, there was a weak level of inflation underlying in the world as a result of a number of factors: technology, emerging markets entering in, and more competition. So we think that the way we've balanced that risk in our portfolio is, as I mentioned earlier, investing in companies that have pricing power and the ability to pass on those impacts. So we are not as concerned. Inflation has always been the monetary authorities were trying to stimulate inflation prior to this pandemic. Inflation is necessary to oil the wheels of the economy. So we're quite relaxed about that. Bond markets may gyrate around short-term earnings data, but we think that we can position the portfolio in a way that is relatively insulated from extreme events.
Great. The next question was actually, how are you positioned to deal with the potential ongoing inflation, but you've answered that already. You haven't discussed Telix in much detail. Can you speak a little bit more about that, please?
Yeah, sure. I mean, I've got some slides in the presentation deck about Telix. It's obviously the largest holding in the portfolio. Still very excited about that. We see quite a lot of catalysts coming up over the next few months, particularly the approval of their first product should happen sometime for prostate cancer diagnostic, sometime between July and September of this year, and then also phase 3 data from their renal cancer diagnostic product mid-year, which also has fast-track approval from the US government. So that could get approved by mid-next year. So 2 products approved in 2022, which I believe will really drive the revenue growth of the company.
Great, thank you. Next question, you have zero exposure to energy at the moment. Does this include renewable energy? And can you please explain your strategy about investing in this space?
Yeah, sure. Well, we do have this negative ethical screen, so we don't invest in any fossil fuels or nuclear energy. So that's the reason for the low exposure to energy in the portfolio. But we are looking for renewable energy. We do have a German solar company, or a German-Swiss solar company called Meyer that's making high efficiency solar panels in the portfolio. And we're obviously looking for other investments in the space, and doing a lot of work on that area at the moment. There's some interesting technology happening in battery management and sort of smart grid technology, where we think how households will spend a lot of money in future on building these clever ways of managing their electricity supply, and that'll be an attractive place to invest.
Great, thank you. Next question: how do you manage currency risk?
Portfolio is unhedged. Obviously, if we're diversified across countries, that helps to somewhat mitigate that risk. We hold our cash in Australian dollars, but we don't actively manage the currency risk. Over the long term, my sense is that whether you're hedged or unhedged, it all evens out in the end. We're trying to invest in very undervalued shares, and I believe the much bigger part of our investment processes is identifying those securities, and the currency kind of is less important in our process.
Well, thank you. A couple of questions now about healthcare. You've obviously got a very large exposure to healthcare. Maybe you can give us some of the reasons why this is such a focus. And in your answer, please incorporate valuations, because valuation risk is obviously high in the Australian context. Is it as high overseas? What do you see as the major risks associated with your large overweight to the sector?
Yeah, sure. Thanks, Adam. It's a good question. I've invested in healthcare for a lot of my career. Firstly, I feel very comfortable investing in healthcare, but the reason I believe the sector is attractive is we've got aging populations. Governments are just bound to spend more on healthcare to look after those aging populations. Obviously, there's healthcare reform going on in the background in most countries. We try and stay away from very high-priced drugs that the target of a lot of these new reforms in the US. The leading products, Telix and Photocure in the portfolio, sell for about $1,000 a treatment in the US, which is high but not outlandishly high. And the great thing is it's a defensive sector, but there's a lot of technology advancements in the industry. So there's some really interesting places to invest and make great returns. Valuations internationally, I believe, are lower in many cases than in Australia. I mean, CSL, I think, is probably a premium. It's a premium company, and that's reflected in the valuation. Of course, you can find expensive companies in healthcare overseas, but I feel like on average, the multiples for larger healthcare companies are lower. Merck KGaA, which is a German company we own, it's a leading producer of equipment to make biological drugs like vaccines. It's trading on 19 times PE, growing 5 or 6% top line. I think that's a very reasonable, generating 4 or 5% of its market cap in cash every year. Not a lot of debt, so I think that's an attractive valuation. And some on the smaller side, you can find plenty of undiscovered companies still that really have interesting valuations. Photocure is our largest holding in Norway. That's about a $400 million US company. It's got $50 million of revenue at the moment, but it's in a $2 billion market, so great potential to grow its revenue over the next few years. Yeah, so I hope that answers all of your question, Adam.
I think it was a compound question, so you did well there. Next question. Why do you believe Howard Hughes is trading at a discount to NAV, and what is the relevance of Ackman's association there?
Look, I think to answer the second part first, Bill Ackman has had a wonderful long-term track record of investing. His company is called Pershing Square, his holding company, and so I think the market does tend to watch what he does, and it is interesting that over the last month he's actually been increasing his holding in this company, and he's actually been reducing his holdings in many other companies. So that's probably important there. The NAV you can break down in great detail using discount rates and cap rates for their real estate assets like offices and hotels, etc. And you can arrive at a calculation of the NAV. Analysts do have there is some variance across analysts, I guess, over exactly what NAV should be used. And one of the factors in that is looking at how much of the retail assets are currently depressed because of COVID. You know, do you take today's NAV, or do you look for the recovered NAV in 1 or 2 years' time as one of the reasons for the variance there? Obviously, the discount rate's very important, and as interest rates rise, the discount rate rises and the valuation goes down, or in reverse if the discount rate falls. And the company has done a great job of putting the sensitivities to interest rates and land prices in their presentation, so you can see those assumptions. And of course, we've got our own models where we do that as well. As I mentioned, they are selling off non-core assets, which I believe will be a catalyst over the next year. They own a very large office tower that's been a premium office tower that was completed in Chicago about a year ago. And I think they're just waiting to see valuations recover in the office market before, and people going back to the office before they sell that. It does seem like premium offices around the world are actually still desirable assets. I guess it's the second and third tier which are struggling more as, you know, more people work from home. So there are a few of the things that I think will re-rate the stock. And obviously continuing land sales, the housing sales in the areas where they exist are actually, the housing sales are much higher than their land sales. So there's a bit of a lag effect between when the builders buy the blocks of land when they complete and sell the houses. So it's very encouraging. And I didn't mention in the presentation, but Texas and Las Vegas have very attractive tax rates compared to the East Coast. So you're actually seeing people move to the Sunbelt states for tax reasons as well, and businesses. So the really good fundamental drivers of their land banks, if you like. So I guess the hard thing to know is exactly how quickly the land prices will appreciate. But I think if we do get inflation in the world, land is a great inflation hedge.
Makes sense. The investment outcome for Immutep appears to be a bit binary. What is the risk of the drug trials not being successful?
Yeah, it does have 2 other drugs outside of the cancer drug I mentioned. So there is some value, but you're right, a lot of the value is in FD. I do like the fact that it's across 3 indications where they've had good data now: breast, lung, and head and neck. So I guess even if it doesn't work, in all three, if it works in one, I think that is obviously enough. That there is a risk. It's got some cash. I think the data they've generated now across those three gives me a fair amount of confidence that we're seeing significant enough efficacy signals that that the drug does work.
Great. And the last question is a concentrated strategy, investing in a lot of smaller companies. What is the sweet spot for fun for the strategy to remain nimble?
You mean in overall fund size?
Overall fund size.
Yeah, look, I mean, ideally, $500-600 million, I think would be great, and that allows us to invest in, a large number of small stocks. I think we'll always invest in some large stocks as well, just as a bit of ballast and for liquidity. But that would be a great number to have, I think.
Great. And we have now answered all of the questions. So thank you very much to everyone for joining us for this update. I hope you managed to get a sense of, firstly, some of the really exciting opportunities that we're currently investing in, but even more than that, a sense of the process that enables the team to continue to identify these great investments. Our next webinar in the series is next Tuesday with John Moog. He is the portfolio manager for the Pengana Global Small Companies Fund. You can register for that and the rest of the webinars in the series on our website, pengana.com. If you have any other questions, please get in touch. We'd love to hear from you. Thank you very much and enjoy your day.